Welcome everybody to another week of 12 weeks of home ownership. As you already know, I'm excited to have you here. I have my girl Krystal here from Goode Tax Resolution, and we're going to be talking about tax preparation, tax benefits of home ownership, and some other things and how you can benefit from her services. So, Krystal, thank you for coming this afternoon to share your knowledge and all your great information. Tell us a little bit about what it is that your company does.
So, gosh, we're kind of all over the place a little bit, but I'm going to try and narrow it down a little bit. But first and foremost, I would say that we lead with tax preparation, and that's for individual and businesses as well, preferably businesses, because that's where I get to be the most creative in helping people save money. We also offer bookkeeping services as well, tax resolution services. So if you get a notice in the mail from the IRS, you know, what do? They say I owe $5,000. I'm the person that you would call to help you kind of navigate that process. We also offer tax planning services. How could I forget? Tax advisory services. And I think that is it. Did I say bookkeeping? Yes.
Yeah, and bookkeeping. Yeah. Yes. All right. Yes. So all your tax needs, basically, yes. Right?
One-stop shop.
One-stop shop. So we're here to talk about, home ownership and, also with how you can benefit from being a homeowner and the tax advantages and all those things. I know if you're renting, your landlord fixes things. You don't have to worry about that, but you are also paying 100% interest on your rent every single month. So we're in the path to home ownership. Right. So what are some tax benefits of home ownership?
So our tax system actually favors the homeowner, and so they do that by way of offering incentives for folks to be able to write off their mortgage interest. So that's, I guess you would call that the debt service, is that right? The interest that you pay on your loan.
Yes, yes.
You also get to write off your property taxes and real estate taxes. The caveat though with those two types of taxes, along with personal property taxes and the income taxes that you pay to your state or local county, is that it's actually capped at $10,000. So if you're making payments, if you're paying more than or close to $10,000 in real estate taxes, you're going to be capped at $10,000 on your tax return if you itemize deductions. Okay. Which is a whole nother topic that we can talk about for the next time. But and also as well, you can also write off the points that you pay to, I guess, buy down your mortgage. Yeah. Is that a thing?
Yeah, absolutely. Yeah. So as you all know, interest rates are normal, right? But in order to get them in order to get your mortgage payment to a lower payment that you may be more comfortable with, your lender will often give you the option to buy points. And Amy talked about that, I believe, in week 3 or week 2 when we were talking to her. But you can write off those points. I mean, those points can range anywhere from a couple $100. Sometimes I've seen people pay upwards of $10,000 in points to get their interest rate lower. So is that capped as well? Is that a separate?
No, that is not capped. Mortgage interest is not capped. There is a small caveat though. It can't be, the mortgage I think can't be over like $750,000 in order, or you can write off interest up to a mortgage loan of $750,000.
Okay, all right.
But while you were talking, it jogged my memory. One of the things that you want to make sure that you watch out for is when you go to get your taxes done, say that you have either bought a home or refinanced your home. One of the things that your tax professional should be asking you for is your closing disclosure form. Because a lot of times what will be listed on that form is not translated over to the mortgage interest statement, which is also something you get at the end of the year. And a lot of times those points that you may have paid are captured on the closing disclosure statement and not on the mortgage interest statement. So it's very prudent to make sure you collect both documents.
Yes, and your closing disclosure should of course, be given to you at closing, but you should also have an email copy to you as well, so that you can keep all those documents in one place, so that you can have access to those to be able to share those with your tax professional when you are ready to file your taxes. So that's good to know. You can write off your points, you can write off your interest, you can write off your property taxes up to $10,000.
Up to $10,000, that's correct.
So if you live
if you itemize.
If you itemize, and if you live in certain parts of Prince George's County,
yes,
your taxes are well over $10,000.
$10,000. That is absolutely true. Yeah.
Prince George's County, shout out to the highest tax bracket in this area. So how do I know if I need tax planning? I know that there's all types of things you can do online now, and then do it yourself. And I personally stopped doing my taxes a long time ago. Maybe when I was 25, I was just like, listen, I can't do it anymore. I don't feel like I'm maximizing.
Yeah.
There is something that I don't know.
Yeah.
And there are certain things that you should just pay for that are out of your expertise. And tax and filing my own taxes is one of those.
Absolutely, absolutely. I think about the taxpayer, who's still doing their own taxes, and maybe they're using TurboTax.
Yes.
And I've seen it. I don't know how to use it, but they're literally just sitting there asking you a bunch of questions. And a lot of times people don't really understand how their responses to some of the questions are going to impact their bottom line. So, as you progress, in your career, start to make more money, buying homes, starting businesses, I would say it's definitely a good idea to engage a tax professional that not only does taxes, but understands the tax law and understands how to implement such strategies so that they can help you maximize how to save money, right? Nobody wants to be paying more for anything.
Yeah.
And taxes is one of them. People forget about that a lot of times.
Man.
We shop around for a good deal, to save money. We should be shopping around for a good deal to save money in taxes, because you never know, there could be some savings there that you can turn around and, make that the down payment on your upcoming house.
And we're not talking about a couple $100s here. Like usually it's thousands.
It's thousands of dollars
that we're talking about. And so if you're talking about being able to save or recoup $3,000-$4,000, right? And of course, I also suggest that when you do transition to a tax professional from doing your taxes, that you also pay to get them to review your past taxes.
Absolutely.
And
last 3 years.
Listen, whatever you can do. If you can do 7, review as much as you can, because I promise you that you've missed something.
You have. Especially when you're working with someone that, is in the business of staying on top of the tax law, because it's something that changes every year. To making sure that they're staying on top of the tax law to, provide the best opportunities and suggestions for your particular case.
Yeah, and the options, right? So I know, I got married last year. I got married last year. Everything happened so fast. And just saying okay, well, this is what your option is if you file married but separate, and this is what your options are if you file married jointly, right?
Absolutely.
And so if someone is just giving you, this is what it is, and they aren't discussing it with you and what your options are and talking you through it, or again, tax planning to how to make this better or offset some things for the future, I feel like you have the wrong accountant, because they're not actually talking you through the process and strategizing with you to be what's in your best interest. So your tax preparer is not trying to get you if they say, well, let me see your last 3. It costs, of course, time is money. To look at these past 3 years or what have you. It's really because they want to see what the patterns are to be able to put you in the best positions.
Absolutely. And the last thing that I'll say here is that, it's also very important for business owners as well to engage in some form of tax planning, because when you're a W-2 employee, you get a paycheck every 2 weeks. Your federal and your state income taxes are already being paid by the employer. Well, it's up to the business owner to actually be proactive and make those payments quarterly throughout the year. And if you don't know how much to pay, then you know, you could be giving away too much, you could be, you know, paying too little. It just depends. So, you know, if you're a business owner, I would definitely say, you know, tax planning. If you own a home, if you're thinking about buying a second home, either for vacation or, you know, investment use, tax planning.
Tax planning.
Yeah.
Okay, so let's say I own a home. I'm ready for my vacation home. So what are the tax implications of that vacation home? I'm not selling my home that I have. I want another vacation home.
Well, okay, so I would say it depends on how you plan. Even though it's a vacation property, I would say it still matters how you use that property. You know, is it going to be a situation where you do Airbnb, you know, for some of the time? Are you planning to stay in the home yourself and vacation there, you know, maybe 14 days out the year? So it kind of depends. So what I would say, for a vacation home, the tax benefits there are going to be greater than they are if it's your personal residence.
Okay.
If it's a vacation home, you can write off all the same things that you can with your personal home, except that, you know, you can also write off repairs, maintenance, you know, the fees that you're paying the property managers to manage the property.
So now we're getting into like itemized deductions.
Actually, no, we're actually getting into rental property deductions.
Okay.
Yeah, rental property deductions, because you can still not itemize and reaping all of these benefits of vacation home ownership.
Now, what if I have a home and I rent out my basement?
Yes. So in that case, your basement, the expenses that you pay on your home would then be prorated to match the square footage of just the space that you're renting out.
Okay.
So you have to take measurements of you know, the basement, right? You have to know that it's a 14 by 14. And then, you know, you have to also claim the rents that you collect as income. So let's not forget about that. Expenses, we're always talking about expenses.
We always talk about expenses.
You also have to claim the income as well, those expenses offset. So in that case, your basement or the cost that you incur to maintain the house will be prorated to the size of the basement.
Okay, so if I rent out a certain portion, that means that I have to also claim the income from that certain portion.
You do.
I just can't write it off
No,
with.
you cannot. It doesn't quite work like that.
Okay.
You know, I'm just saying once every single red cent.
So what if I am selling my home? Okay, so I know this is a little beyond, you know, first-time home buyers, but if you're a first-time home buyer and you want to sell your home in a couple years, and I make $100,000 off the sale of my home.
Okay.
I have to pay taxes on all of that. Like, how do I avoid capital gains taxes? How do I, you know, maneuver that situation? Just some like basic information. I know every situation is different per person.
That's right.
But how does that work?
So generally how it works is there is a tax law, section 121 of the tax law says that if you sell your home for less than $250,000 as a single person, then you're able to exclude up to that amount of money on the capital gain that you realized. If you're a married person, then you get to exclude up to $500,000 on the gain that you realized. So, you know, a lot of people think that when they sell their home, oh, I've walked away with $100,000. Oh my God, I need to pay tax on this money. Well, Section 121 comes in and saves the day and says, no, you don't, because.
So I don't have to pay taxes on my. Okay, if I'm married, and we buy the house for, you know, we have to. The cost of the mortgage that we owe left on the house is $700,000.
If it's your principal residence.
Yes, it's our principal residence.
And you have lived in it in the last 2 years of 5.
Yes.
That has been your principal residence. You do not have to pay taxes up to $250,000.
Well, that's nice.
Yes, it is.
It's all cash.
And it's all cash. And one of the things that you kind of tying this back into tax planning, once you're getting to that point of selling your home, you know, you should be having those kind of conversations with your tax professional to help you prepare for a potential capital gain to something that's beyond $250,000.
Okay.
So, and how to deal with that, right? Because if you do have a capital gains tax, it's likely that you'll be paying about 15% on that money, which is still a great deal because it's less than your marginal tax bracket,
Right.
which is potentially about 20
To 33.
to 33%, excuse me. 37%.
37% is the highest tax bracket.
is, yeah.
But if you're paying 37% as a tax bracket, I feel like you need tax planning to lower that bracket.
Absolutely.
40% of your money is going back to
Yes, and
the
we're not even
government.
talking about state income taxes. That's just federal.
That's just federal.
Yeah.
I'll say. All right, guys, thank you for tuning in. Reach out to Goode Tax Resolution. The information will be below so that you can reach out to her directly and her company. I hope you all have a great week. Thank you for tuning in. Peace.